Hello, everybody. Welcome to today's webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Our webinar title today is Trading Strategies that Turn Stone into Gold. Welcome, everybody. My name is Shane Chu. I'm the moderator for this webinar. And today, we are going to explore step by step how do we design a trading strategies that can consistently generate profits to us. Okay, what are the right strategies or right step to build and design your strategies so that it can withstand the test of time and become a profitable strategies. All right. So before we begin, as usual, disclaimer: whatever we share in this session is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decision, you're 100% responsible for all your investment risks. Allow me to briefly introduce our speaker today. He is a distinguished CFA charter holder and Chief Operating Officer of Optimus. With 10 years of experience, he brings a wealth of experience and a proven track record of success. He was a former equity research analyst and also a proprietary trader. He spearheaded a team that emerged as champions in the inaugural Bursa Invest Hack 2020. He is none other than Mr. Charlie Yuan. So Charlie, how are you today?
Hi Shane, hi everyone. I'm feeling really excited today because I'm delivering a very special topic.
Yep, this is going to be a very advanced class this evening, so we can't wait to learn from you, Charlie. Perfect.
Okay,
We are seeing your screen right now.
all right. So let me start. Okay, to the most ambitious, most open-minded trader and investor, good day to all of you. I'm really happy to be here today. Today's topic will be relatively advanced, and it will be how we craft trading strategies from a more high level point of view. So me personally, I do like automated trading and also quantitative trading, which means that we go step by step. How do we actually go through one step at a time and then craft the final strategy that we want? So most of you may have known a lot of platform that you can craft strategy and then let it run on the platform. But how to do it systematically will be today's topic, and it will be fairly technical and then it will be fairly advanced. So bear with me. If you have any question, just feel free to drop in the Q&A box, and I will address all of them at the end of the session. So any question, you can just drop in it, and then we will address all the question at the end. Okay, so disclaimer for myself is education purpose. Okay, so let's dive right into the framework. So so by having a strategy, we need to know our end goal. So what kind of strategy do we want? So first of all, I will introduce a framework that I proprietary built it up, and this framework, with this framework, you guys can actually easily know whether a strategy is working or whether it is like just a normal strategy, or conversely, it may be a weak strategy. So by having this framework in mind, then you can test it out, test it on on any, maybe any teacher or guru strategy, and then you see whether the result of the backtesting or the result of how you run the strategy, how is it based on this framework. So without further ado, I will dive right in. Okay, over here you see a 3D framework. 3D framework, this is brainstormed by my team and myself. So you see a triangle over here and you see 3D. And the first D is direction. So direction wise means that how well your strategy, this is actually a framework to gauge your end goal of your strategy lah. So we start with the end in mind and to gauge whether a strategy is working or is profitable. So how do you gauge it? You are using this 3D framework lah. So this 3D framework start with the first one, direction. So in particularly in Bursa stock market, we are looking more towards upwards movement because normally we buy low and sell high. So whenever the stocks goes higher, then we will profit from it. So direction wise, we are actually predicting whether the direction of the trading strategy, whether it will predict whether most of our stock or most of our buy and sell will yield a upward direction. So with this, it's always good to have a upwards direction rather than a downward direction. This is the first D, so we are predicting the upwards direction and the probability of ensuring it is going up is the strategy we want to tackle on. The second D is durability, which means that whenever the stock goes upwards, whether it's a strong movement, strong momentum movement, or a weak momentum movement, if it is strong, then it will go higher even after it will go stronger lah, which means that the volatility of the stocks going up higher will be bigger so that you will earn more. And that is one of the second component of the durability. So we want strong durability stock strategy instead of weak durability. The third thing we are looking is the duration. So whenever a stock goes up, and even though it's very strong upward momentum movement, we are also looking at the duration. So if the stock can goes up longer, like let's say a few days or a week, then generally you will be earning more because the stocks is going for a longer tenor. Longer tenor means that you are actually holding towards a more upwards movement stock with a longer time, and then your chances of profiting with a bigger amount will be higher with a longer tenor duration. So this 3D, how do we measure them? It's based on the inner circle wording. For direction, we are measuring it with a win rate. So which means that if probability you are predicting the stocks is going up is 70%, that means actually 70% of the time you are right, and then when you buy, the stock will goes up. So this is a good strategy. Second, durability is by reward over risk. Reward over risk means that whenever 1 ringgit risk you are risking, how many times of reward you are getting back. So let's say if you are predicting the wrong, predicting the stock and then you eventually turn into a loss, you are losing 1 ringgit. But then every time you predict the stocks in the right direction, you are winning 2 ringgit. That means your reward over risk is very high and is 201, and not say very high, but it's considerably good lah. 201. So in the long run, your reward is higher than risk, at least 201 ratio. Then that means overall when you are right, then you'll win more. And when you are wrong, then you'll lose less. So this is the magic of reward over risk. This is just a general overview first. The next few slides will dive more into it. So if you are still not sure what I'm saying, then it's okay because it's just a general overview lah. And the third one is average gain over average loss. So whenever the stock have a longer duration, you will see that your average gain, whenever you are winning in a position, your average gain will be higher than your average loss. So let's say 10 trades, 6 trades you are gaining, and then this 6 average is average every trade you are winning 2 ringgit. Then for average loss, you are losing 1 ringgit. So 201. So it's also a ratio. So with these three going hand in hand, we will see a good net profit in your strategy. So these three contribute to the net profit of your strategy, and it will constitute to a good strategy for you. And that's what we mean by with the end in mind. So by having a good strategy with both all these three available, then you can craft a good strategy with a high net profit. So the first one is actually direction. So I spell out the definition as well, the likelihood that a given trade will be profitable, uh, and most of the time we are in Bursa stock, so we are looking into a upwards long position. And the measurement metric is win rate, like what I mentioned just now. So the formula of win rate is number of winning trades over total number of trades. So let's say you trade for 100. So your strategy, you buy, sell is one full trade lah. Then you buy, sell again is another full trade. So add up, you have 100 full trades. Out of these 100 full trades, you may be winning 70 of the trades. So 70 of the trades you are winning. So by calculating the win rate, you will get 70%. And here's another. Suppose a trader made 100 trades in a month. Out of these 60 trades were profitable, winning trades. So 60 over 100 is 60%. So that means that trader has a win rate of 60% for that strategy. So this is very clear cut, and I believe most of you can understand. Durability means that the strength of a price trend likelihood to grab higher reward in the direction of the price movement. So let's say we already predict that the stock will be going higher, and whether it's durable means that whether the strength of the price trend movement, whether it's high or not, that's the second thing we're looking at. And the matrix that we are measuring is reward over risk. By reward over risk means that your potential profit over potential loss. Potential profit, let's say you bought a stock at 2 ringgit and you see a potential profit is you will TP at 2 ringgit 40 cents. So 2 ringgit 40 cents minus 2 ringgit, you will get 40 cents. So that's actually your potential profit. And every trade you enter, you do know your cut loss point. So 40 cents, you may cut loss at 10 with a loss of 10 cents, then you will cut loss. So 40 cents over 10 cents, you will get 4 over 1. So there's a reward over risk. So this is a clear example. A trader buys a stock at 5 ringgit, set a target price at 6 ringgit, and a stop loss at 4 ringgit 50 cents. So over here, we see that the entry price is 5 ringgit. Take profit price is before we enter a trade, we already know what target price that we want for that. Depending on strategy, some strategy you may have a target price. The other strategy you may just like trailing along until the strategy goes the opposite direction. So target price minus your entry price, you will get your potential profit. 6 minus 5, you get 1 ringgit. And the potential loss is 5 ringgit minus 4.5, your stop loss price, and you get 0.5. So 1 over 0.5, you get reward over risk of 2. So this is the second component of knowing a strategy is good. Third thing is duration. Duration is the length of the time during which the price of an asset consistently move in a particular direction before reversing or consolidating. So whenever we predict it's going up, we do hope that it will last long. So by having a longer time of duration that the price is going up consistently, moving in the direction, upward direction, then we also can ensure that our average gain is higher. So whenever you win, you want to win more. Whenever you lose, you want to average, you want to lose less. So that's the calculation. So the formula is average gain is this formula. You sum out all your gain and you divide by your gaining trades. So let's say you have 10 trades and your winning trades is you have 5 winning trades and 5 losing trades. So over here you see you win 200, 150, 100, 250 and 300. So the total gain is 1000. So you sum up all the gain over here. You can see my mouse cursor. The sum of the gain is 1000. And 1000 divided by 5, you get 200. So your average gain is 200. And on the other hand, average loss, the losing trade that you had was 50 ringgit loss, 100 ringgit loss, 75, 60, 90 ringgit loss. You sum up all your losing trade, you get 375 and you divide it by 5 because there are 5 trades and you will get 75, negative 75 for average losing loss for your trades. So by dividing 200 divided by 75, you will get your average gain over average loss. And 200 divided by 75, you get 2.67. So for this calculation is an example calculation. At the end, we will provide a sample spreadsheet for you so you can key in for your trade and then monitor how is to track your trades, how well is that. So this is more at the start it will be more theoretical, but at the end we'll introduce maybe a tool for you so that you can, it's a free tool and you can just key in and then you can actually monitor all the three metrics that I've made, all the three metrics that I've just addressed to you lah. So of course, you say if I'm looking at three metrics, how do I know which one to prioritize? Of course, in this realm of backtesting or trading strategy, there's a lot more knowledge, and one of it is this called expectancy, because sometimes it's not necessary when your win rate is high, then your trading strategy is good. Because if your win rate is high, but every time you win, you are winning a little bit, but when you are losing a lot, then generally your strategy will also make you lose a lot of money. Conversely, if you are having a low win rate, but then every time you win two times, three times, then it's actually also a good strategy. So how do we conceptualize and capture this information in a single formula? And one of it is actually expectancy. Expectancy actually will capture this direction and also this duration, which is win rate and also average gain over loss. So what's expectancy? Expectancy is a measure of the average amount a trader can expect to win or lose per trade over a series of trades. So let's say the expectancy is higher for this strategy. That means that overall, this strategy is better for that period compared to another strategy. Win rate, like what I mentioned earlier, the calculation is stay the same. It's the direction win rate. Let's say this is 70%. Average gain, you get 2, 70% times 2 minus lose lose rate will be the opposite of win rate lah. So if the win rate is 70%, then the lose rate will be 30%. If average gain is 2, average loss is 1. So maybe I can draw it out lah because I didn't put in slide. So 70%, and every time you win. Average gain, you get 2 ringgit, and lose rate, you get 30%, and average loss is 1. So you do the calculation, you will see that 1.4 minus, you will get 1.1. So how do you know whether it's good or not? Obviously, it's above 0, then it's actually is a profitable strategy if as long expectancy is above 0. And if above 1, then it's even better. So this is one way to capture whether a strategy is good or not. For those that just entered, today's topic will be relative at once. Uh, so, but then at the end, we'll provide something that you can use as a tool for you to conceptualize what you have learned for the entire session now. And so expectancy wise, you will see that it's a good strategy. Okay, so that's the first end goal in mind. And by having the end goal, we still need to have the input. So this will be the input part. So how do we craft a trading system or trading strategy? So there will be 12 components. This is a very full-fledged component of a trading system or trading strategy. And it's particularly useful in stock because in maybe other instrument like futures or structure futures lah, probably of the time, you'll be only trading one instrument. But then in stock, it's actually irrational that if you have a trading strategy, you will be trading one stock at a time. So we are actually looking at trading multiple stocks at a time. And with a strategy that can form a portfolio of stocks is actually a full-fledged, is a big picture of quantitative trading in the stock market. So what are the 12 key components? So the first one is objective. So objective, uh, the key components, the first one is objective. Objective means that what is the objective of your strategy? So what do you want to achieve by having this strategy? Do you want to have a wealth accumulation? Wealth accumulation means that you want to gain a long-term wealth by using this strategy, or do you want to have a money cash flow? Money cash flow means that every month you can withdraw certain amount from your account, and then it's a consistent um, consistently monthly you will be earning a good cash flow based on this strategy. So here you already have two kind of different kind of objective. Wealth accumulation is more will lead you to a more long-term strategy, while money cash flow strategy will lead you to a more short-term, or we would say is a more mean reversion strategy, which means that whenever you have profit, then you will take it, and instead of instead of looking forward that it will go in the long run, that it will profit a lot, we are looking at a shorter tenor to profit. Whenever profit, I'll take it and build the cash flow consistently in every month. And also, of course, there's different kind of objective, but then I won't really dive them into it. Even your return and profit objective, which means that how much are you looking into? Because whenever your profit objective is higher, most of the time your loss will be higher as well. Because when you have a higher risk tolerance, you want to have a higher profit, then co- consecutively you may have a larger loss at the same time. So your return and profit objective is something that you want to look into, because a strategy that can makes you 10x, 20x, their drawdown, which means that their potential loss may be higher as well. Of course, there are strategies that have low drawdown, low potential loss, and they have a high profit. But then there's actually there are only a few of them, and their style objective, different kind of style, and some of you will be long bias because we are looking that our economy or our stock market will be going upwards in the long run. So that's why most of us have a long bias for our stock market. Or okay. And time frame, some people just don't want to hold overnight. Some people want to hold overnight. So there are different kind of objective. So by knowing your objective, then only we can craft our strategy. So these are the input. So this is the first input. So I already talked about the output, which is the win rate, the average win over average loss, and return over risk. This is the input part. The first input is objective. Second input is belief. Sometimes even you you need to have your objective align with what you believe on. So how do you measure and know what you believe on? That one will actually based on your backtesting evidence, which means that we are looking into something, the numbers, and see whether the numbers fit into what we believe on. If sometimes we believe that we want a money cash flow strategy, well, every month I can withdraw some money out. But then there's also pros and cons for each kind of strategy. So whether that kind of strategy fits into your belief, that one uh will actually you need to look at the backtesting result, and then you will need to look at it, the number of the outcome of the strategy. Then only you will understand whether your belief align with that strategy. Of course, these two are more general. And coming up next is trading universe. So trading universe wise is actually for stock particularly, because in Bursa Malaysia there are around 1,000 stocks, and some other countries there are even more stocks. So what kind of trading universe do you want? Do you want only what is trading universe? Trading universe means that which which part of stocks you are looking into. Let's say I'm looking into only Bursa Malaysia stocks. So I will ask you whether you are looking into main market, ACE market only, or you want main market. You want main market or you want to include ACE market also. So this is the trading universe. So you need to specify a trading universe. Whenever you want to design a strategy, you need to specify a trading universe to a programmer or to a coder. They want to code your strategy, then you will need to tell them your trading universe. I want the entire Bursa Malaysia main and ACE market stocks in my trading universe. And some examples of trading universe includes index component. If some companies only want to trade the top KLCI component stocks. Some people only want to trade fundamental sound stocks. Some can go into all stocks. Next one is filters. So because sometimes we need to filter some stocks because not all stocks are worth our time to trade. Some stocks are not liquid. We may not be interested in low liquidity stocks, which means that the volume of the stocks at daily volume or weekly volume of the stocks is very low. So even if you bought into the stocks, you can't easily exit the stocks. So that's actually something that we do not want that to happen. So if the stocks is actually not that liquid, whenever we buy in the stocks, we are we are trading, we are not investing. Investing and trading is different. Investing, we are looking into a longer tenor. But then trading, we want to make a quick profit or just a swing trade for a few weeks. When we enter, we want to ensure that when we exit, we can exit easily. So that's why liquidity plays a very big part. So you can filter out those not so liquid stocks. The next thing is share price. Sometimes whenever we see penny stocks or stocks that has less than 20 or 30 cents, those stocks are not so viable for trading as well because uh they may be low, they are priced low for a reason, and they whenever you enter a stock, you may face a lot of hurdle for the stocks to increase in price. So all these are some price filter that you may apply to to that you will need to think of. So all these are inputs, and all these inputs will apply for your. You will need to tell a coder whether this what filters you want. So you want to exclude stocks less than 20 cents. You want to exclude stocks greater than 5 ringgit. So these are something you need to tell them. And volatility means that whether the stock is volatile or not. So this can be a filter as well. So if you only want volatile stocks, then you may use ATR to measure volatility. So high volatility stocks will let you have more potential gains, which means that the stock is going up a lot and going down very quick. So up down very quick means that the range is very big, and that means also your potential profit and loss is very high also. So you can have all this filter. So after all this filter, we'll come to the fifth component. There's 12 components, so we are in the fifth component. So the fifth component means that you are actually have a quantified rules through your technical indicators. So all this technical analysis or technical indicator, we want to have meet certain criteria, then we only buy into the stocks. So let's say I have a setup called uptrend setup, and whenever the close is above 20 moving average, then I will buy into the stocks. So this is one of the setup, and is actually this actually is what most teacher or guru will mention about their technical indicator, and then how do you see all these technical indicator, and then Whenever a certain pattern is formed, then it's a buy for you, and whether certain pattern is formed, then it's a sell signal for you. So this setup is what normally most of the people guru will say lah. But then this 12 component is even more comprehensive. It's not only the setup. Setup maybe a easy setup will be a price. Whenever the price is above maybe 10 moving average, then I will buy into the stocks. Then if let's say I'm using this method, then actually there's will be a lot of stocks. There may be a lot of stock that will be appear in this setup. So what should I do? Because we are trading stock. If there's 150 stocks appearing with price above 10 MA, it's impossible for me to buy all 150 stocks. Let's say I just want to buy 5 stocks at a time. What should I do? As long as I have this setup, but there's 150 stocks generated. So it comes to our next point, which is ranking. Ranking means that from this 150 stocks that I have the bullish setup, I have the uptrend setup. I rank them both. I rank the 150 stocks based on another technical indicator, and the highest 5 stocks with the strongest technical indicator, then I will actually buy the first 5 stocks. So let's say price over 10 MA is the setup that I want, and ranking could be price divided by 10 MA, which means that the price is furthest away from the 10 moving average, and the higher it is, I will see it has a stronger momentum stocks. Then I will use this criteria to find there's 150 stocks. So I will rank the stocks. The higher the price over 10 MA, the highest one will be here. I'll buy it. Second, third, fourth, fifth. I'll buy the first 5 stocks with the highest price over 10 MA. And then this is the ranking. So there's 150 stocks, but not necessarily I'll buy all 150 stocks. I just want to buy the first 5 strongest stock. So this ranking prioritize will give us priority which stock to trade when we have more setups. Then our maximum number of position allow us to trade. So let's say I have found 100 to 150 candidate of stocks, but only want to buy 5 stocks. So I can rank them. This is one way to rank. This is a trend method. Volatility, I also can rank with an indicator called ATR, average true range. The higher volatility, I may want to prioritize it. And there are even more technical indicator for you to rank the stock. So after you rank it, for sure you want to enter the stocks, you want to buy in the stocks. So there are a few kind of ways for you to enter a position. One way is market order. Market order means whatever whatever price is offered in the market, I just want a quick position. I want whatever is given in the market, I want to buy. I want to guarantee that I have the position. I want to guarantee that I have the stock. So this is called a market order. Another way is actually a limit order. Limit order means that you are buying at the if you want to buy, you are setting your order price at a lower price. So you are trying to buy at a lower price and you want to profit from a higher range. So entry wise for a position, there are 2 kinds. One is market order and one is limit order. So really depends on what kind of strategy fits into this entry condition, and you will decide whether you are market order or limit order. Of course, this is trading and this is not investing. Investing, you may not have a stop loss, but trading always have a stop loss in mind because you need to really save your capital, protect your capital. Because if you don't have a cut loss, then eventually when the loss grows bigger and bigger, your psychological will be greatly impacted as well. So you need to know where's your exit point. In every entry, stock entry, you need to know when do you want to cut loss. so that you know what is your maximum loss and you won't exceed the maximum loss. And of course, there are different kind of risk management way. If you are interested, you can look at this rock. Okay, so stop loss. So this is the 8 component. There are in total 12 components. So by knowing your stop loss, then you also will need to decide on whether you want to re-enter. Because every time you are buying a stock, after you exit the stock, whether you want that stock to enter back into your trading universe. If you want, then you may buy, repurchase the same stock at a later time again. So this is actually a condition that you want to decide on as well, whether you want to re-enter your stocks at a later time after you have exited the stock. The 10th part is profit protection. So for profit protection, it means that there's 10 is profit protection and 11 is profit taking. So for profit protection means that we are trailing our profit lah. So let's say this is the market. I enter here. I enter here. And then when I enter, I have an initial stop loss. But at the same time, whenever I profit, then I want to move my stop loss level higher. So when this one drop down, I will stay it. When it goes back up again, then I will move my stop loss higher and then stay back up higher. Then consequently, if it drop back down, then I do know that uh at this level, I have a profit protection, which means that the stocks, whenever it goes up higher and higher, the stock goes higher and higher, I will not just set my stop loss, but I will also set my profit protection. So whenever it goes higher, at least at a certain point of time, when the trend reverse, then I will protect my profit. And this is called profit protection, and it is particularly useful for momentum based or trend following strategy. So whenever there's a strong trend, I will keep my profit protected, and whenever the trend reverse, then I will actually exit the position lah. So trading stops, this is called a trading stops. This is called a trading stops, and it will actually trail whenever you have profit, then you will also have a higher trading stop for your position. Trading stop loss may be separate stop from what you put in place when you first enter. So when you first enter, you have a stop loss, which is here, or you can call it the initial stop loss. But whenever you have profit, then you will have a profit protection or trading stop moving higher. So then when the trend reverse, then you will exit the position. So mean reversion strategy is a different kind of strategy. So mean reversion strategy is more applicable for profit taking. So profit protection is more towards trend following strategy. And mean reversion strategy is more applicable to be used with profit taking. And profit taking means that whenever you enter a position, you do know that at what price level you have a fixed target price. Whenever it hits, then you exit the position. So certain kind of profit taking will be 5%. If you purchase this stock at this level, with a 5% profit, then you will actually take profit and then you are good for the day. So this one kind of profit taking. And this is this is called 5% profit taking lah. And certain strategy you will measure using time stop. Time stop means that uh for 3 or 4 days, let's say the stocks consolidate when you buy the stocks, but then it consolidate for 3 or 4 days, then you will also exit the stock as well because for the 3 or 4 days, there's not much movement, and then the stocks may not be in a strong position. So it's better off you use that your cash flow or your capital in a stock that has greater movement. So that's why profit taking, you may be using a fixed 5% profit target. Like let's say once you hit 5%, then you exit the position. Or you have a time stop. Whenever 3 or 4 days there's not much movement, then you will continue, you will leave this stock and continue with another stocks. This also, this is the 11 component. And of course, for stock, because we have a fixed capital, we have the last component, which is a very crucial component, which is the position sizing. So let's say you have you want to buy 5 stocks, you have 100,000. So you need to allocate this 100,000 into 5 stocks. Which stock you want to buy with a greater amount, which stock you want to buy with a less amount. This will all based on your position sizing. So there are different kind of position sizing method, and the easiest way is the equal method, the percent size with an equal method. Equal method means that let's say you have 100K, then you want to buy 5 position, then you will equally divide 100K divided by 5, you will get 20K per stock. So you equally allocate 20K for each stock, then you can actually safely say that you have a position sizing that have equal risk in all, equal size in all 5 stocks. So equal size doesn't really mean that you have equal risk, because the size is just that the amount of capital you put in each stock. This is the easiest way for you to allocate your stock. And yeah, so if for someone new, then you can use this method. Let's say you have 100,000, you want to buy into 5 stocks, you don't have preference which stock will go higher or which stock you are more confident in, then you just equally divide your capital by 5. Then you get 20K for each stock. Then this 20K is the amount of capital. Let's say the first stock is RM1. So you can buy RM1. That means you can buy around 20K volume of stocks. And let's say 20K for the next stocks. Let's say the stock is 2 ringgit. So how much you can buy? So you can actually buy 10K volume of the stocks. 10K is 10K is like that, 10,000. And it's actually a 100 lot lah, if we go by the lot size. So by buying 100 lot, you are actually using up your 20K portion of your 100K. And how do you decide which position size to use? One way is, first you need to decide what method. There are 3 methods over here. And the second thing is you need to decide how many stocks that you want to buy into. So let's say you want to buy into 10 stocks, then you will use you need to divide it by 10, but if you want to, let's say you want to buy 5 stocks, then you divide by 5. So percent size equal method is the most straightforward. So after knowing this 12 component of what to input, then we'll move into how do we develop our strategy. Because we already have our input, we already have our output. What we are missing now is the middle part. How do you turn your input into your output and craft a strategy that can outperform the market? So in terms of systematic trading strategy, we always have a fixed plan. Like whatever mentioned, we will need to tell the computer. Computer is actually, they go by logic. So whatever logic you give them, then they will execute accordingly. So all of this you need to craft it step by step. So the 12 component is something you need to tell the computer in order to craft the strategy lah. So by going a systematic way, the more crucial one is the entry. How do you enter a how to enter a stock based on certain technical indicator, let's say price, above 10 moving average. So this is the entry criteria. Let's say price drop below 10 MA, then I will exit. This is the exit criteria. Filter, probably the price is above 30 cents. Then only I will buy stocks that is above 30 cents. I'll filter out the stocks. Ranking, like what I mentioned earlier, price over 10 MA, the stocks is greater in momentum. So the higher the number, I will buy the stock. So that's the ranking. And position size, I just want to buy 5 stocks with equal position. So this is the most clear cut. So with all this, I can actually craft my trading strategy with these steps. Of course, you will see that I'm using 10, but let's say if I'm using 20, I'm using 40, I'm using 80, my my profitability of my strategy will be different. So I need to test out for each parameter and to test out whether my profit per trade is higher, and I also can find the optimum point of that moving average. So I can use profit per trade. Profit per trade means that I use the total profit I divided by total number of trades and days since entry. So this is another parameter. So if I hold the stock based on this strategy, I hold it for let's say 20 days. It's actually the optimum point for a 10-day parameter for this moving average. So I will actually can see that I actually know that based on my profit per trade, it will be higher at the 20th day. So every time when it reaches 20 day, it's best for me to exit this position. So you can run with different kind of X and Y axis criteria lah. Of course, there are different kind of exit rules, including reversal and non-reversal. So from here, you can see that this is a reversal exit rules because whenever price is higher than 10 MA and the opposite is price smaller than 10 MA. So this is like the opposite part lah. So this is actually the reversal technical indicator lah. Of course, there's non-reversal as well. For example, price greater than 10 MA, I will enter the position. Price greater than 10 MA and 5 MA, I will enter the position. So need to meet two conditions. But when exit, I just only want price less than 5 MA. So this is a non-reversal condition lah, because this is not the exact opposite. And of course, exit rule, there are different exit rules. Loss stop, this is our stop loss. Exit rule, including our stop loss. We had our hard figure stop loss. And percentage, we may set 5%. Whenever a strategy hits a 5% loss for that trade, then I'll exit the position. So this is actually a percentage stop loss. Hard figure means that if let's say it lose for 10 cents, I will exit that trade as well. So all these are set in stone so that you can predetermine your stop loss before you enter the market. Time stop, like what I mentioned earlier. So a few days, if there's no movement, I want to move to the next stop. So the time stop in place. Profit stop is also there. So let's say whenever I have profit, I want to protect my profit. I also have a trailing profit for my criteria. Okay, so these are some ground rules to address a trend following strategy lah. And okay, so this is some rules lah. So this you guys can just look it through lah. Let me see. I'll just straight dive into the strategy making part. Filter I mentioned earlier. So there's eight process to develop a strategy. The first one is formulation. Like let's say the formulation means that you need to formulate what is your 10 moving average. Because my strategy is price greater than 10 moving average. So actually, you need to clearly define what is your 10 moving average. You need to have a mathematical form of 10 moving average. So how do you calculate 10 moving average? You need to add up price for the first day up until previous 10 days minus 10. Then you add up all price and divide it by 10. So this one you will get 10 MA lah. So this is the formulation part. So after you know all your formulation of a technical indicator, then you will go into computer testable form. So you will need to run the program and let it whether this can be coded into your computer. So formulation is maths, and the second step is actually programmer. So you need to tell the code how to program this 10 moving average that you want. And the next step is preliminary testing, which means that you need to find a quick way to back test to see whether it will give you profit. So the preliminary test will allow you to gauge whether you want to continue testing this strategy lah. Of course, this is a very simple strategy and it will definitely not be profitable. So by running a preliminary testing, you will actually judge whether you want to continue with this strategy or not. Next step is optimization. Now I'm using the last 10 days. What if I use 20 days? What if I use 50 days? What if I use 100 days? Which one will give me the most profit? So this is the optimization part. You need to test using different kind of parameter. And if the strategy is a good one, most of the time, regardless which parameter you use, you will be your strategy will still be profitable. So optimization only give you the best number that will yield you the most profit in the recent times. And this only comes after the first three steps lah. So after optimization, you will need to evaluate your performance and robustness. So performance, we have already addressed some of them. One is the win rate that we mentioned earlier. Win rate. And second thing, maybe average win over average loss. So this is something we also can address. And by calculating all this, we will know whether this strategy fits into our belief and objective or not. Expectancy is another one. And then if all these five components are passed, we already passed all these five, then we will trade our strategy in the live market. After trading, you will monitor whether your trading performance your live trading, whether it tallies with what you have tested. Because sometimes you test your strategy may not tally with what you have done in live market. And once you monitor your trading performance, you can refine and evaluate your trading strategy lah. So you can refine and revise your trading strategy. So this is the 8 steps. Particularly in the 6 steps and 7 steps, 6 steps is trade the system. So most of the time, some people back tested their strategy and they found it very profitable. But then one problem is they did not stick it through. So this is actually a very big problem because whenever you test a strategy, if you run a strategy, but then you only run for a small period, smaller time frame, you actually are not trusting your strategy. So whenever you test your strategy is profitable, you should have maybe 3 months, 6 months testing your strategy and sticking your strategy until the testing period is done. Because if you don't stick it through, you are actually you are not giving time to allow your strategy to prove that it's profitable or not. So you need to stick it through at least 3 months, 6 months to measure whether the strategy you have is good or not. Of course, as a strategist of a strategy, you need to gauge different kind of risks, and also there's a lot of drawdowns of different kind. Drawdowns means that the potential loss of the strategy, because not every time you are buying into a strategy and then you'll be winning. But then let's say you are buying at the wrong time, then the drawdown will be higher. And also after the 3 months, then you need to evaluate whether you should continue trading the strategy or you need to stop trading the strategy. Okay, so backtesting is very important. So backtesting, by only backtesting your strategy, then only you have the first filter whether your strategy work or not. And backtesting itself has a lot of knowledge in it. And after backtesting, then only you will live trade your strategy. So always backtest strategy first, then only you live trade your strategy. Instead of just whenever strategy you have, you just trade it. That's not the good way for you to trade a system or a strategy lah. You need to backtest the strategy first. So we can actually leverage on trading tools to achieve your trading aspiration. One way to backtest your strategy is you may there's a lot of platform but then one of the platform that you can use that can backtest the strategy. Wait, I can't switch window. Okay, so one of it you can use this one called Trade Wizard, and you can go to market and you can go to this one tools. This one you go to screener. So by going to screener, there's actually a quick backtesting tool. So like what we mentioned just now, a price above 10 MA, price above 10 MA. So this is a trend indicator. So you can just test it out. So price above 10 MA and maybe more parameter, 20 MA, 50 MA, 100 MA, but less than 150 MA. So this is one of the criteria. And can test maybe price above 30 cents, like what I mentioned earlier. So you can use a module called backtesting down here. And you can go back in time. Like let's say based on this condition, I go back to yesterday, 25th of June, and I bought the stocks that appear in the screener based on this criteria, and I buy it for hold it for 1 day, so I can just screen it. So let's say, based on the criteria, I would have this stock listed, and based on the back testing, I have stocks that yield me 2%, 1%, some are negative 1%. So this is actually a very quick way for you to back test based on portfolio method, and you can just quickly use whatever technical indicator you want, and then you can input into here, and then you can put the back testing. Let's say I want 1 week ago, 18, and I hold for 1 day. So can quickly go back to 18th of June, and then we can see that by holding for 1 day based on this criteria, I could bought BYIC and have a return of 4%, but at the same time, I could have bought Switch and yield a loss of 5.8%. So there are, of course, there are a lot of backtesting tools in the market. I'm just introducing one of them. So uh, for there's a lot of strategy lah. So some of the strategy I just want to demonstrate that using this framework that I mentioned, the step by step, the 12 component, and then step 1 to 10, 8, we can actually draw out the strategy and backtest it, which yields this one is yielding 25 times since 2016 until now. It yields 25 times based on 100,000 capital. So in Malaysia stock market, there's actually a lot of potential. And with different kind of strategy, you can, by backtesting it, you can see the equity curve yield from 2016 until 2024 latest is 24 times, and the drawdown is the potential loss of the strategy. You can see it yields the highest was 14%. So the fail matrix that I mentioned is win rate is 0.47. So even though the win rate out of 100 trades, 47 trades you are winning is less than 50%, but then your average win every time you win, you are winning 5.6% to average loss. That means that every time you win 5.67. Every time you lose 1. So even though the win rate is less than 50%, but then it's a very, very profitable strategy lah. So from here you can see lah, the win rate and these two are the two metrics that we introduced at the start. This is another strategy. This is a 20 times strategy since 2016. But this one had a big crash during COVID, 40% drawdown. Win rate is 53 and average win over average loss 3.81. And this another strategy. And like what I promised earlier, we actually uh have a tool. This is a free spreadsheet, and then this free spreadsheet will actually let you calculate you can actually input your stock, and then you can calculate what we mentioned earlier, which is your win rate and also your average win over loss. So you can track based on your strategy. You can enter the transaction into the strategy, and then you can actually see whether your strategy works or not. This is one way of the logic. And if you want to get this spreadsheet, you can just email the organizer. Then I will pass this spreadsheet to the organizer, and then the organizer will send it to you, so you can write into uh, write into the organizer lah, the email that you guys received this webinar. Okay, the next one is Q&A session. I'll address the question. Uh, this this session is relatively advanced lah, but then I hope that you can understand that in trading system, trading strategy itself, it has a lot of knowledge in it, and then it's actually there's a lot of thing to learn from it. And even though you don't understand everything I mentioned today, I do understand that you may not understand everything, but then it's something for you to take note of, so that you can actually look one by one, and then you can build your way towards automated trading or quantitative trading, which is the next big topic in Malaysia, because there's a lot of development coming in, and quantitative trading is definitely coming into Malaysia in a very near future lah. So we see a lot of automatic trading, quantitative trading in overseas like US, Singapore, Malaysia. They are for institutional, but then for us retailer, we will see it coming in soon as well lah. So it's always good for you to learn all this kind of knowledge, know how to do all this strategy crafting, so that you have a strategy in mind, and then you have a profitable strategy to trade in a more cutting edge technology lah. Okay, thank you. I'll pass the Q&A moderator back to Shane.
Thank you so much, Charlie, for sharing with us your framework in our devising our trading approach, as well as 12 key ingredients in designing and devising our trading strategies. This session looks kind of heavy, and if you have any questions you have in regards to the session, anything you cannot digest, but please write your question in Q&A box here. Q&A box, not the chat box. Please write them at the Q&A box. The first question I see is my screen is that, do you have any recommended tools that we can use to filter or analyze the stocks? This question is asked by Jennifer.
Okay, so recommend tools to use to filter or analyze the stocks. Uh, for backtesting wise, uh, you will have fairly limited lah. So let's say you want to you want to screen stocks, then you can use trading wheel, can use KIC screener. But for backtesting wise, most of the time you will need a lot of programming knowledge because you will need to code yourself to actually backtest the strategy. So in a way, you can try the website that I mentioned just now, which is called Trade Wizard. They have a backtesting module, which means that you can actually enter your trading strategy. Like let's say the trading strategy I mentioned just now, you can enter in as a trading indicator, and then you will go back in time. There's a backtesting module. You will just go back in time and then you buy all the stocks based on the criteria that you want, then it will move forward to let's say 5 days, 1 day. Then you will gauge whether overall whether your trading criteria will yield you profit or not lah, based on the criteria. So there's actually a tool you can try it out lah. It's called Trade Wizard, and then you can use they offer free trial as well lah. Okay.
Is it tradewizards.com?
Yeah, uh Trade Wizard. You just
Just
Google
Google
Trade Wizard.
trade wizard, okay?
Yeah.
Right. So the next question is do you recommend any other back testing tool besides trade wizard?
Okay, if you do know how to code a bit, you can use Trading Wheel as well. Because Trading Wheel, you can code strategy inside and then you can automate where to buy, where to sell, and then everything can be automated. But the bad part about Trading Wheel is that you are running a strategy on a single stock. So you are not running on a portfolio. So let's say you want to test your strategy based on based on a pool of stocks. You can't use TradingView to do that. So TradingView allows you to do backtesting based on individual stocks. Let's say you want to test it on Maybank or Inari or any stocks. So you need to enter the trading strategy, and then they will have a they will show you the result as well lah, the win rate, average win to average loss that I mentioned just now. Everything will be shown on trading wheel, but the bad part is trading wheel only allows single stocks. However, if you are backtesting on futures or other single instrument, that is actually a very good way to backtest it lah. But then for stock, we do know that it's very different. Stock, we have 1,000 stocks, and it's illogical for you to backtest only one stock, and also illogical for you to buy every single stock at a single point of time. So it's always a trader always switch stock, right? So today I'm looking at this stock, another day I'm looking at another stock. So all these, if you want to backtest based on portfolio wise, then there are less option in the market lah. So you can look into the trade wizard lah if you want to backtest based on portfolio. But if you are backtesting based on single stock, then trading wheel is a good thing. And of course, now we have ChatGPT, a lot of strategy. You can just ask ChatGPT to brainstorm for you, and then you just put into trading wheel in the Pine script. Then it can run and yield the entry and exit point, and then eventually you do know your result based on your strategy. Yeah. So trading wheel, if you want, you can look into that.
Thanks, Charlie. So for the cut loss strategy, what would you suggest? Would it be based on percentage or absolute amount? So this is a question by Mahalingam.
Okay. So for cut loss strategy, for myself, I will set maximum 8% because 8% is actually a very strong psychological level. when you calculate the cut loss and also how many percent to regain back from your loss, if you are losing 50%, then you need 100% to regain your profit. But if you lose 8%, you will just need 8.8%. So it's just less than 1%. So one of the cut loss I will put is 8% in most of my back test or strategy. And this is more towards the hard cut loss. And cut loss itself, there are two kind of cut loss like what I mentioned earlier. One is the initial cut loss, and the other one is actually based on the indicator So that one is profit protection. So for initial cut loss, I would recommend 8%, regardless whether you are using quantitative trading or you are trading based on in a real market. 8% is actually already a very psychological level for your cut loss So if you set 8%, uh, and then you admit your loss, and then you do not let it continue the loss to accumulate, then it's actually a very good learning point for yourself already So at the start, you can put a 8% cut loss, and then that is actually the initial cut loss, and the cut loss or profit protection is based on technical indicator. That one you can try on maybe average true range from your moving average, or even some trailing stock, maybe moving average. All these are potential candidate for your profit protection component So however, for the initial one, you can start with the 8%.
All right, so 8% is your preferred cut loss percentage. And uh, in regards to that cut loss percentage, right? May I know your style? Is it like a swing trade, position trade, or intraday or scalping?
Okay, so the 8% that I mentioned is more towards like swing trade
Swing trade,
So swing trade. Uh because uh swing trade wise, you are allowing a greater portion of loss because you are also aiming for a longer tenor, right? Longer tenor, and then you can actually profit over a longer period. So by having 8% for a swing trade is still reasonable. However, for intraday, if you are looking to it, intraday trade, whether it's a momentum based or a scalping method, then I would say 2 to 4 ticks is already something you need to be to for your cut loss So let's say you bought in the stocks 2 ticks from the entry price, of 3 or 4 ticks from the entry price is something you already should actually cut loss. Because for intraday, you are actually conserving your capital for intraday trade. You need to recycle your capital. So if you lose 8% every time, then it's actually a big amount already. So likewise, for intraday, if you want to have a better risk management or cut loss position inside, then 2 to 4 ticks is actually it's already something you need to cut loss a day 2 ticks means that if it's below 1 ringgit, it's 0.5 cent is 1 tick. Above 1 ringgit, 1 cent is 1 tick So that's 2 to 4 ticks Yeah.
Right. Thanks, Charlie. Ashar would like to ask this question. So, out of the 12 key components in crafting a trading system, can you highlight what are the 3 to 4 most critical ones that new investors should focus on?
Okay, so I will assume that you are looking into uh stock, and stock itself will definitely have just look at your trading broker platform. So what you need to enter into the trading program platform is the thing that you need to focus on. So what are them? One is the price, one is the volume, and one is the stock selection. So out of all these 12, you will say price is definitely based on the setup. So setup is definitely one of the critical one. So with a great setup, then only you can buy a winning stock. Is the setup. Second thing is your volume. You need to key in your volume. So that one is position sizing. So position sizing wise, you can actually enter your position sizing into you need to allocate your capital based on the position sizing rules that you want, and then you allocate to how many stocks that you want to trade on. So there's the second one, and the third one is stock selection, whether you want to buy or sell. Stock selection wise, will be the rest of them, which includes entry. Uh, we- okay, so let me repeat it again. S- stock selection will be our setup and also our ranking. So we need to set up what setup of the stocks that we want, and we rank them based on our criteria. Second thing is the volume. Volume is actually the position sizing. So the second critical area, and the third critical area is our entry order lah. So whether what price we want to enter, we want to use a limit order or we want to use a market order for that strategy. So if you really want me to summarize the 12 points, then I will summarize it in this way lah. Based on your broker platform, you will need to key in what stock you want to buy, what price, and what volume. So with all these three combined, it's actually the main thing to craft a trading strategy lah.
All right. Thanks, Charlie. The next question is by Lily. Could you please explain role rack management?
Okay. This Ray
Ra rock management.
Okay. Okay, so this is actually something I will just briefly explain it lah. So railroad management actually you can Google it actually. So it's actually measuring when you are winning, then what is the potential time frame, how many days you hold the stocks, and then the because when you are in the real trade, most of the time you won't buy at the lowest, and most of the time you won't sell at the highest. So this raw management will actually tune you to see what if you have the potential to win at the highest and buy at the lowest and sell at the highest, and roughly how many days or roughly how your strategy should be adjusted to fit so that so that uh so that your strategy works better lah. So raw is something like that lah. So it will better poise you to manage your cut loss point and also will poise you to manage your take profit point. So because we do know that it's impossible for us to take profit at the highest point, so with the raw management, it will adjust the cut loss. So if your cut loss is too tight, then you will always cut loss and then you always exit your position. If your cut loss is too big, then you may actually lose a lot, then only you exit the position. Same things go to take profit. It's also have the same ideology inside lah. So if you want to adjust your cut loss and take profit level, then you can actually research on the raw rock lah. Yeah.
Yep, I think RAROC stands for risk adjusted return on capital.
Okay. Thank
The
you.
next question is by Navid. As a physical trader, do we look at fundamentals or technical charts in pump trade?
I believe you are looking at FCPO lah, palm oil trading. Uh, there are obviously different kind. For what for the topic I mentioned today will definitely skew towards technical analysis, other apart from fundamental lah. So quantitative wise, technical is more quantifiable. Fundamental wise, there may be some metrics that can be applied to as a strategy. For example, the production level of CPO, national level, that one you can actually see it from MPOB. All these statistic, let's say you tabulate daily because they release the statistic daily. Let's say you tabulate statistic daily, and then you use this statistic to form a trading strategy. This is considered a fundamental input already. So that one some that one so but this kind of fundamental input, most of them are not in number form lah, because let's say FCPO, there's a lot of factor that may affect our palm oil, including the weather, including the our or there's a lot of factor inside lah. So and not all of them are quantifiable. So if you want to have a more quantifiable and also more straightforward way, then we will actually look into technical analysis lah, instead of fundamental. Of course, fundamental wise, you can also apply as a quantitative trading or quantitative backtesting method to test whether your idea works or not. Because all this backtesting will actually requires numbers and requires numbers to gauge whether based on the past this number appear, then your trade works or not. If you are basing them on fundamental factors that are not quantifiable, then it won't actually work lah. Yeah. I'm just giving you the possibility lah. I'm not saying that fundamental cannot be applied in what I'm talking about today lah. It can be applied, but then the data are more limited lah. Yeah.
All right. The next question is, can you please guide us some example of stock screening based on technical indicators with the value in the trading view?
Okay. Uh, Guide you. Okay, so trading wheel. Okay, so let me. I'll just briefly talk it through lah, because
No screen, right?
tr-
Because
go.
we're not looking at we're looking.
Okay,
Yeah,
so
now
trading
I
wheel
see screen.
screener. Obviously, they have fundamental and also technical insight. So whatever you need to change to more markets, then you need to change to Malaysia for Malaysia stocks. Then they have all kinds of metrics. So for screening, you need to click this screener settings. No, wait. Think okay, they changed their layout already. So this is one of the new one. They can see chart in the screener. Okay, so trading view. This is the table form. Table form, you see different kind of data, including price, change percentage, market cap. Uh, Pardon me, because for some time I am not using trading view screener already. Last time when you just click, then you can actually add
All right.
the screener. I I need to
Would you want to take the next question?
yeah, take the next question.
All right. So yeah, I think so for this question, you can go back and do your homework. All right. So just spend some time to navigate TradingView platform to check out how the screener works. The next question is, how do you suggest the warrant trade on the Hong Kong exchange? Is it essential to do day trading or short term with uh, time specific cut loss point? Or would we be better if we do a percentage-based cut-off points? Any preference? Have you done
For
warrant based on Hong Kong underlying trades very often?
yeah. So on HSI particularly, so for structure warrant on HSI, we're actually looking into day trade more lah. Because why? Because there's actually one thing called time decay in structure warrant. The longer you hold a structure warrant, then the time decay will be bigger, and that means the value of the structure warrant will decrease faster. So if you really want to have a higher probability of winning in structure warrant, then day trade will be best lah. Of course, you may hold overnight, but most of the time, I will suggest not to hold over weekend lah. Because over weekend, you are actually having a greater time decay. You are losing Saturday, Sunday as the calculation for time decay as well. Because structure warrant has a limited time, there's a limited tenor, and at the end of the tenor, the nearer you are to maturity of the structure warrant, the time decay will be faster, and then you will lose more in the structure warrant value faster. So structure warrant wise, there's different kind of structure warrant screener as well lah, including Macquarie, Kananga. You can go to because they are issuer of structure warrant, so you can actually look into their screener, and then you can actually screen stock based on few criteria. One of it is sensitivity lah, based on HSI, because a lower sensitivity structure warrant, you can actually have a bigger gain. One of the thing I look into is sensitivity lah. Sensitivity means that HSI move for five. If the sensitivity is 5, means that HSI move for 5 points, then your structure warrant will move up one level, and you can actually profit one tick lah. So screening wise for HSI structure warrant, you can look into that for all the issuer screener, and for cut loss wise, you can actually, or time holding wise, I would suggest intraday trading. And really you see a potential, then you can hold during weekdays, but weekends, uh, I would suggest not to hold lah, because the time decay is very harmful for the price that you will get. Yeah.
All right. So that's all the time we have for question and answer today. So thank you so much to Mr. Charlie Yuan, who is the Chief Operating Officer of Tech Optimus, for doing this session for us. I guess that all of us here have learned a great deal from Charlie. How do we design and devise our trading strategy following the 12 key ingredients that he just shared. All right. Thank you so much, Charlie.
Thank you, Shane. Thank you, everyone. Have a good day ahead. Bye.